Good afternoon, everyone. Welcome to the Business Legacy Summit's video blog. I'm Dr. Greg Fisher, co-founder of Accelerate Business Development Services, an adjunct professor at the University of Northwestern in St. Paul.
Excellent. And I'm Noor, managing shareholder and executive director with Boulevard Wealth Management. Today, we're doing a deep dive into something every business owner must face eventually, and that's succession planning and your transition options.
We often refer to this as the second mountain. As a founder, you've spent years or decades climbing your first mountain, building a successful company. But transitioning away from that business is an entirely different climb. It requires a new mindset. And what I like to say is what got you here won't get you there.
Yeah. Yeah, it really does require different thinking, doesn't it, Greg? Right.
Yeah.
Many business owners wait too long to plan. Succession planning isn't just an exit event, it's a long-term strategy to secure your legacy and your personal financial freedom. So let's take a look at how a business matures to that exit stage.
Yeah, if you look at how a business matures, it follows a fairly repeatable pattern. In simple terms, after you've built that business and it's been going, you can identify the value drivers, and then you want to protect those value drivers from risks. And then you build out and build up, and eventually harvesting and managing that wealth.
So to scale that ladder, right, we use a four-stage legacy and wealth blueprint, right? So the first stage here is to envision, to build strategy. And then secondly, we're de-risking to shore up that value. And then we're growing to accelerate that value and increase the market multiple. And then finally, we're transitioning or harvesting that wealth to fund our legacy and wealth goals.
Yeah, Troy, I know that you have a formula for looking at the harvest step, and maybe you can talk about that a little bit here.
Yeah, absolutely. So yeah, there's a lot to weigh here, right? So what you do is you take the percentage of your net worth tied up in your business, you add your age to that, and if that is greater than 130, it's time to take some chips off the table and diversify some of that wealth.
And that calculation will require a business valuation, which should be performed regularly, advisably at an annual pace anyhow. And that brings us to the final stage, which is what sets you up for what we call the legendary exit. But to get you there, you must have some idea of the potential paths and options. So broadly speaking, your succession options fall into two distinct buckets. There are internal transition options and external transition options. And I just want to mention on the external option side that we're not going to be talking about IPOs today, which is an initial public offering. It's an entirely different thing. So Troy, let's start with the internal options.
All right. Yeah, Greg, internal options are fantastic if you want to preserve your corporate culture, right? The first and most common is a sale to existing internal partners, right? The pros of this is that it is controlled and it causes very little disruptions. And the new owners are typically motivated and understand the current operations. The cons are that partners usually expect a lower internal price. And if you haven't funded your buy-sell agreements, right, it can take a long time to get paid. So as you go through this, be very aware of competitive camps, competence gaps, and plan accordingly.
Yeah. Another path on the internal side is intergenerational transfer, passing the torch to family members. Surveys indicate that about 50% of closely held business owners want to execute this path, but in reality, less than 30% actually even take the first step down the path. The pros of intergenerational transfer are that it preserves your business legacy and can drive motivation within the family. On the con side, it can actually strain family dynamics and family relationships if roles aren't clearly defined. And family members often lack the liquid cash to buy you out, forcing the owner to carry a lot of financial risk.
Right. All right. Then we have the management buyout or MBO, right? This is selling your business to the existing executive team. The pros are is that you have high business continuity and the buyers are often motivated. And your key personnel is locked in. The cons are that managers are rarely seasoned entrepreneurs. They might have competency gaps when it comes to ownership, and sellers most almost always do not have the liquidity to buy you out. So you have to finance a bigger portion of the deal.
And the last inside option that we'll talk about is the employee stock ownership plan, or an ESOP. This transforms your employees into owners. The pros are that it provides incredible tax advantages. Gains can often be deferred by the owner, and shares in the business for the employees are purchased on a pre-tax basis. The cons of an ESOP are that it's fairly complex, it's highly regulated, and therefore it's expensive to set up. They also require, because of that complexity, a much longer timeline for the founder to actually execute that exit option.
Yeah, very good. Now let's look outside the company walls, right? If your primary goal is to maximize cash at closing, external options are usually the answer. The most popular route is a sale to a strategic or financial buyer, right?
Mm.
The pros are that this yields the highest valuation and gives you upfront cash, a faster exit, and no family discord. The cons are that the due diligence process is brutal and very stressful. Buyers almost always frequently they require earnout, so that ties you to the company years after the sale, right? So we have to weigh that very carefully.
And there are options for owners who aren't ready to walk away from the business completely. And one of those options is recapitalization via private equity. The pros here are that you can get a partial exit. You get cash out now. And while you're retaining equity for a second bite or even multiple bites of the apple when the business grows and sells again later. This option also injects some serious growth capital into the company. The cons are that sometimes you lose absolute control, and even for a minority stake, you're accountable to a partner or potentially a board, which can cause somewhat of a culture shift.
And then finally, if the business cannot run without you, there is the orderly liquidation, right? The pros are that it is efficient and simple if your tangible assets are worth more than the operating business itself, right? The cons are that it leaves nothing behind for your legacy. The taxes are generally higher, and that it's tough on employees and the local community.
Yeah, my dad liquidated one business and he sold another business to a financial buyer. The businesses were the same kind, and both were located in rural environments. And it reinforces the notion, as a business owner, you can't time the market. You have to be prepared at all times, and that just provides the best overall business strategy, is being prepared at all times.
Yeah, excellent. Now, Greg, I want to mention that these options, they're not mutually exclusive, right?
Mm, that's true. So let's talk about common combinations for a second. We mentioned taking multiple bites of the apples. And so owners can stack it up if they plan well. And this requires time, again. So this is what's referred to as multiple bites of the apple, as we've already mentioned. And we'll explain briefly how some of these options work. This is not an exhaustive list of what could potentially happen. It's just a few of the more common ones. So we'll explain first what a minority equity sale looks like, followed by an external sale.
Yep. In this case, an investor with a minority stake provides liquidity to the owner and injects growth capital for growth. And take some of the chips off the table, as we say, and then maximize liquidity through an external sale.
Yeah. Troy, what about the equity recap with an internal tail?
Excellent. Yeah, again, the owner takes some chips off the table to secure personal wealth while retaining corporate control. The external partner provides capital and oversight needed to train up junior management for an eventual buyout 3 to 5 years down the road.
And the third one we have here is a two-step MBO.
Yeah, in this case, speaking of an equity buyer, the owner gets immediate liquidity at closing. The management team secures an ownership stake that they otherwise couldn't afford, and the equity firm gets a proven leadership team to run the company.
Take a couple seconds, Troy, and talk about the phased intergenerational transfer with followed by an external sale.
Yeah, this is a very good one. It generates steady retirement cash flow for the founder through a structured sale while ensuring the business is managed by competent professionals rather than unqualified relatives.
And finally, on our short list here, we have a leveraged ESOP with an external tail.
Leveraged ESOP, known as the LESOP, right? So the leveraged ESOP, right? So an initial ESOP rewards loyal employees, right? Lowers corporate income taxes, and then provides the owner with initial partial liquidity, right? And then the final external sale maximizes the remaining equity value.
So it's kind of cool. Some of these options, in addition to providing multiple bites of the apple, really have some nice tax advantages as well.
Absolutely. Yeah.
So, Troy, before we wrap up, I think we also need to share a few tactical truths that slides alone don't show. First, clean up your books early as a business owner. External buyers, when they're looking at buying a business, they will walk away instantly if your financials are messy.
Yeah. And then second, build a management team that can run, that basically makes you obsolete. If the business cannot function for 2 weeks without you answering the phone, your business is not ready for sale, or at least not at the maximum value. Right?
Absolutely. And last, know your post-exit number. You must work with your wealth advisor and financial advisor to calculate exactly how much net cash you need from the sale of your business to sustain your lifestyle and your future purpose on that second mountain.
Excellent. So we call it the wealth gap, don't we, Greg?
Yep.
Right? Basically it's taking a look at how much do we need, how much do we have, and then how do we fill that gap, right?
Mm-hmm.
So to figure out the next steps, start by asking yourself a few core questions, right? What does your lasting legacy look like? Right? What are your true financial needs? And then do you want to stay involved or do you want to completely exit?
So these are, some potentially difficult choices to make, and you don't need to navigate this alone. If you want to build your own legacy and wealth blueprint, reach out to us. You can email me at greg@acceleratebds.com. And my phone number is 877-807-1155.
Yeah, excellent. And you can reach me at troy@boulevardwealth.com. That's troy@blvdwealth.com. Or you can reach me at 877-664-2583. That's 877-664-2583. Thank you for watching, and here's to planning your legendary exit.
Thank you, everyone, and blessings.